Good morning and welcome to this live event. I'm Tobias Adrian, the Financial Counsellor and Director of the Monetary and Capital Markets Department of the International Monetary Fund. I'm very happy to welcome you to the Michel Camdessus lecture. Due to the COVID-19 crisis, this is the first time that this lecture is virtual. This is a lecture series devoted to the challenges faced by central banks, in particular on monetary policy topics. We're very happy to welcome you here from Washington, D.C. We have an audience from around the world. This edition is the 7th in a series of lectures, and previous lecturers have included a variety of speakers from central banks. We are very honored and privileged to welcome Thomas Jordan, the chairman of the governing board of the Swiss National Bank, for this year's lecture. His lecture will commence in a few moments and will be followed by a conversation between him and the managing director of the International Monetary Fund, Kristalina Georgieva. Before that, it is my pleasure to first give the floor to the managing director for her opening remarks.
Thank you very much, Tobias. Ladies and gentlemen, dear colleagues and friends, welcome to the 7th Michel Camdessus lecture. It is our signature lecture series on the role of central banks. And it is my privilege to join Tobias in welcoming and introducing to you our speaker today, the chairman of the governing board of the Swiss National Bank, Thomas Jordan. Before I turn to the governor for his lecture, let me state the obvious. It is a very unusual time we are gathering in this virtual conference room today. The world is facing a crisis like no other, one that is more severe and more complex than anything we have seen in our living memories. For all of us, this means supporting those who are most affected, especially those who have lost loved ones, and those whose livelihoods are at risk. That means adapting and rethinking our lives and our economies. And that brings me to what we are going to be discussing today in this first ever virtual Camdessus lecture. When we were planning this event back in January, and Governor Jordan agreed to be our speaker, our theme was lower for longer interest rates environment and the challenges it poses to monetary policy. And it now looks like that because of the crisis, this topic is even more relevant because we are faced with likely lower for even longer interest rates. We discussed this challenge during yesterday's conference on advances in monetary economics, which was organized by the IMF's Monetary and Capital Markets Department, and in which many of you have participated. Thank you for that. As you know, the IMF recently cut its global growth forecast to minus 4.9% for 2020. And we project only a partial and uneven recovery for 2021. The good news is that governments and central banks around the world have taken extraordinary fiscal and monetary measures. These actions have done the needed to put a place where the global economy would not sink any further, in other words, to put a floor under our feet. But there is still a great deal of uncertainty for the future. We are definitely not out of the woods. And in fact, the current environment raises key questions for monetary policy. How can central banks best support the economy once they have exhausted conventional policy space? And how can they avoid unintended consequences, such as asset markets that may become detached from economic fundamentals, something that we all are seeing as a risk? What other instruments are in the toolbox if circumstances become even more challenging? What more can they do? How will higher debt levels and weaker balance sheets affect demand for credit? How they would affect the natural rate of interest? And what does it mean for the conduct of monetary policy going forward? And what will be the impact of lower for longer on financial stability, both domestically and externally via spillovers? Difficult questions, uncharted territory. But we can benefit from those who have successfully pioneered unconventional approaches. And that includes, fortunately for us, Thomas Jordan and the Swiss National Bank. As a small open economy, Switzerland has been frequently affected by external economic shocks. Policymakers have responded with creativity and resolve. Think of the European sovereign debt crisis in 2011. At that time, SNB introduced an exchange rate floor to help safeguard its economy. Switzerland and the franc are considered safe havens, and policy choices during shocks are often particularly challenging and unconventional. A few years later, in 2015, a negative interest rate policy was introduced to deal with deflationary pressures, a policy that remains in place to this very day. And again, this was an innovation that others have been monitoring very closely. Thomas, who has served on the SNB governing board since 2007, just before we were hit by the global financial crisis, has played a key role in shaping these policies, including as head of financial markets by overseeing regulatory work before being appointed chairman of the governing board in 2012. And in this position, he's joined by two other board members, Fritz Zurbrugg and Andrea Mechler, both of whom previously served in senior positions at the IMF. And this is just one of many connections between our organizations. I want to thank the Swiss authorities, Thomas personally, for engaging deeply with the IMF, especially through generous financial support for our regular and concessional lending resources, debt relief, capacity development, especially in the Caucasus and Central Asia. These are countries that Switzerland represents on our board of directors. International cooperation is part of Switzerland's DNA. It is a key priority for Thomas. After the global financial crisis, he worked with other policymakers to draw up new capital standards for systemic banks. And these stronger buffers have benefited economies in the current crisis. The SNB is also working with other central banks to help address climate risks. This includes finding ways of better integrating those risks into banking supervision. I expect many know well Thomas and his excellent work and leadership at the SNB. But let me add one more thing you may not know. Thomas is noted for having excelled at water polo, one of the world's most demanding sports. It requires extraordinary agility and situational awareness, creative game plans, and bringing teammates to pursue a common goal in a challenging environment. Some of the key ingredients that have then impacted his distinguished career and make him so very valuable at this time of crisis. So, who better to quiz on the working of monetary policies in the current environment but Thomas? Who better to ask for help to redesign monetary policy in this crisis and beyond but Thomas? And I'm so very deeply honored that we can now turn to you, Thomas, to deliver the Michel Camdessus lecture. Very much look forward to listening to you and then continue in a conversation on your insights on monetary policy in difficult times. Welcome, and for all of us, we are so keen to engage with you in an exciting conversation. Thomas, the floor is yours.
Well, dear Madam Managing Director of the International Monetary Fund, dear Kristalina, thank you very much for this nice introduction. Well, one advantage of water polo is that you always come back to the surface, even when you stay for sometimes on the water. This is really helpful in these times. Now, ladies and gentlemen, it gives me great pleasure to speak to you today, although for most of you only virtually, unfortunately, due to the coronavirus pandemic. Dear Kristalina, I'd like to thank you and the IMF very much for the invitation to give this year's Michel Camdessus Central Banking Lecture. This is a great honor for me and for the Swiss National Bank. I have had the privilege of meeting Michel Camdessus several times, and I hold him in high esteem as an impressive personality and a far-sighted decision maker. Allow me also to pay tribute to you, dear Kristalina, for your strong leadership of the IMF at this critical juncture. The work of your institution is crucial for overcoming the current global crisis. Now, the coronavirus pandemic presents the world with enormous challenges. In my speech today, I will focus on some of these challenges as they pertain to monetary policy in Switzerland. In recent years, the Camdessus lecture has been given by central bank governors of large economies. These central banks shape global monetary policy. I, on the other hand, speak as the central bank representative of a small open economy that conducts its monetary policy against this global backdrop. Now, even before the outbreak of the coronavirus pandemic, the monetary policy situation in Switzerland was not easy. In January 2020, in other words, even before the first coronavirus cases were recorded in our country, inflation was just 0.2%. At the same time, the S&P policy rate of minus 0.75% had already been at a historical low for 5 years. Not so long ago, we could hardly have imagined nominal negative interest rates. Let me briefly explain how this extraordinary situation came about. As a small open economy, Switzerland is highly exposed to external disruptions. Exchange rate movements, in particular, exert a major influence on inflation and economic activity in our country. A further characteristic of Switzerland is that the Swiss franc, as a safe haven currency, tends to appreciate when global risk sentiment deteriorates. In recent years, a number of crises, notably the global financial crisis and European sovereign debt crisis, have led to appreciations of the franc. What does the strong influence of developments abroad on inflation in our country mean for our monetary policy? Well, it means that inflation can be controlled with even less precision than in large currency areas. it is not possible, or only with disproportionate use of monetary policy instruments and consequently market side effects, to always fully offset spillovers from abroad. For this reason, a definition of price stability that allows a certain flexibility in monetary policy response is essential for Switzerland. According to the S&P definition, price stability is considered to prevail when the inflation rate is less than 2%, but still positive. This has yielded good results. In addition to the aforementioned crisis, the international low interest rate environment has also exerted upward pressure on the franc. The global decline in the level of interest rates over recent decades is mainly due to structural factors, and thus to a decline in the equilibrium rate of interest. No country can detach itself from this global development, and certainly not Switzerland with its open capital market. The global fall in interest rates increase the upward pressure on the franc. Historically, nominal interest rates in Switzerland have been substantially below those abroad. Besides the usually lower inflation rate in Switzerland, this also reflects our country's political stability and the credibility of our institutions. In response to the global financial crisis, the central banks in the major currency areas lowered their policy rates close to zero. In Switzerland too, monetary policy easing was necessary. However, there was less scope for interest rate cuts here than abroad due to the already lower interest rate level. The global decline in interest rates therefore narrowed the interest rate differential with other countries, which led to additional upward pressure on the franc. Following a series of appreciations, the Swiss franc was at times significantly overvalued. This posed considerable challenges for companies in our country, and inflation declined repeatedly into negative territory. Given this situation, how was the S&P able to conduct the expansion in monetary policy required in this low inflation environment? Now, we carried out substantial interventions in the foreign exchange market and temporarily introduced a minimum exchange rate against the euro. At the beginning of 2015, we then lowered our policy rate below zero. This was done in order to at least partially restore the usual interest rate differential with other countries and thus alleviate the upward pressure on the franc. Now, the S&P was one of the first central banks to lower its monetary policy rate significantly into negative territory. Let me therefore say a few words about our experience with the negative interest rate, which has now lasted a good 5 years. On the whole, negative interest has proved its worth for Switzerland. The transmission of negative interest to the economy in this country occurs primarily through its impact on the exchange rate. Negative interest has passed through the money and capital market rates and thereby eased upward pressure on the Swiss franc. This has helped to ensure more appropriate monetary conditions for the economy. It is less clear to what extent the negative interest rate also has an effect via the credit channel. However, we introduced negative interest not because of its effect on the demand for credit, but because of its influence on the exchange rate. In Switzerland, the negative interest rate has thus had the intended impact. But there have also been side effects. Negative interest poses a challenge for banks, pension funds, insurance companies, and savers. It may also have negative consequences for financial stability if the search for yield leads to excessive risk-taking. The decision to impose negative interest therefore requires, like all monetary policy decisions, a cost-benefit analysis. While the benefits of negative interest in relation to the exchange rate occur immediately or quite quickly, possible side effects only become apparent over time. With regard to financial stability, our experience shows that macroprudential measures, in particular the countercyclical capital buffer, help to limit the undesirable impact of negative interest. In order to further reduce the side effects on the banking system, we also grant the banks a considerable exemption threshold. Negative interest is thus charged on only a portion of their sight deposits at the SNB. Now, ladies and gentlemen, even though we still have scope for further interest rate cuts, the fact remains that one cannot lower interest rates indefinitely. For this reason, interventions in the foreign exchange market, in which we buy foreign currencies and sell Swiss francs, also play an important role in our policy mix. Since the global financial crisis, the central banks of many large economies have implemented extensive securities purchase programs known as quantitative easing or QE. By contrast, the SNB has intervened in the foreign exchange market. This has several reasons. First, the capital market in Switzerland is relatively small, which naturally limits the size of a QE program. Second, the capital market in Switzerland plays only a subordinate role in the transmission of monetary policy, as comparatively few large companies use it to finance themselves. And third, in Switzerland, the upward pressure on the franc was the main reason for the, at times, very low inflation. Against this backdrop, for us, foreign exchange market interventions were and still are the most direct and the most effective instrument besides the negative interest rate. When deciding on whether to intervene, it is vital, just as with negative interest rates, that a continuous cost-benefit analysis takes place. On the one hand, this is the benefit of preventing an excessive appreciation of the Swiss franc and thereby stabilizing price and economic developments. On the other hand, foreign exchange market interventions expand the SNB's balance sheet and have caused our investments in foreign currencies to rise sharply. Therefore, interventions increase financial risks in the longer term. The responsibility to manage our assets in the best possible way and so to limit the risk of potential loss has thus also increased. For this reason, we invest a significant proportion of our assets in stocks in order to improve the risk-return profile of our investments. Our experience shows that foreign exchange market interventions and the negative interest rate are essential for a small open economy with a safe haven currency in a global low interest rate environment. The combination of these two monetary policy instruments is more effective and results in fewer undesirable side effects overall than concentrating on just one of them. Ladies and gentlemen, a strong franc, low inflation, and negative interest rates, this was the monetary policy environment in Switzerland at the beginning of this year. And then came coronavirus. The pandemic and the restrictions imposed in many countries to contain the virus brought parts of the economy to a temporary standstill. Not only coronavirus, but also the economic downturn spread unusually quickly across the entire world. In the first quarter of this year, the Swiss economy experienced the sharpest downturn since the oil crisis in the 1970s. Furthermore, the second quarter is likely to be considerably worse. Inflation has declined once again and has fallen clearly into negative territory. What is the task of monetary policy in Switzerland in this situation? As always, the aim is to ensure appropriate monetary conditions. In this specific case, it is also about providing banks with the necessary liquidity so that they can supply the economy with credit. Many companies have experienced severe sales losses due to the restrictions imposed on their business activities and the lack of demand for their products. While revenues have fallen away, a large part of the cost continues to be incurred. These companies therefore need swift access to financial resources to bridge the loss of revenue. In the current situation, however, the line between liquidity and solvency problems is blurred for many companies. To ensure that banks do not hesitate in granting new loans, the Swiss government set up a program through which it provides guarantees for corporate loans. With a minimum of red tape, companies are able to apply for such guaranteed loans from their account holding bank. Following a brief check, the loans are approved and paid out. In this way, even small companies with no existing credit relation can obtain bridging loans quickly and at very favorable conditions, with an interest rate of 0% for amounts up to 500,000 francs. Within the first week after the start of the program, every 10th Swiss company had received such a loan. This figure has since risen to a good 20% of all companies in Switzerland. The SNB is offering the banks a new facility for refinancing the loans guaranteed by the government at our current policy rate of minus 0.75%. The so-called SNB COVID-19 refinancing facility increases the bank's liquidity and their capacity to grant credit on favorable terms. Getting a loan program aimed at mitigating the economic consequences of coronavirus pandemic up and running so quickly depended on close cooperation between the government, central bank, and private sector. Not only has the coronavirus pandemic presented Swiss monetary policy with new challenges, but it has also exacerbated the long-standing problem of upward pressure on the franc. Two drivers have been decisive here recently. First, the monetary policy easing by major central banks through purchases of securities and interest rate cuts pushed down foreign yields. As a result, the interest rate differential with Switzerland narrowed once again. And second, the high level of uncertainty about the economic outlook led to a flight to safe haven currencies such as the Swiss franc. Our combination of negative interest and foreign exchange market intervention thus remain more necessary than ever. In recent months, we have intervened more strongly on the foreign exchange market in order to alleviate the upward pressure on the franc. Ladies and gentlemen, I hope that I have been able to give you an insight into the special situation in which Switzerland finds itself as a small open economy. Our experience underlines how exposed small countries are to international developments. Spillovers from abroad require continuous adjustments to our monetary policy and sometimes difficult decisions, taking into account comprehensive cost-benefit analysis. In an environment of low interest rates worldwide, we are forced to find new instruments to ensure appropriate monetary conditions. Negative interest and foreign exchange market interventions have served us well. However, the Swiss experience also shows that monetary policy in small open economies cannot always fully absorb disruptions from abroad. Our definition of price stability, which allows a certain flexibility in the monetary policy response, is therefore essential to our country. Monetary and fiscal policy in Switzerland have complemented each other well to cushion economic consequences of the coronavirus pandemic. However, the experience with coronavirus in particular also illustrates the importance of a clear division of roles between monetary and fiscal policy. Monetary policy is not the panacea. It must not take fiscal and structural policy decisions. Responsibility for these policy areas must remain with the government, even in the event of a crisis such as the coronavirus pandemic. Finally, I would like to say a few words about the outlook. The economic recovery will take time. Expansion in monetary and fiscal policy is therefore still necessary. Meanwhile, even for countries like Switzerland, which entered the crisis with low levels of public debt, the sharp rise in new borrowing will be an issue for years to come. In the longer term, inflation could rise again due to the global increase in public debt. The challenge will then lie in identifying the right time and the right pace for monetary policy normalization in order to ensure price stability. It is uncertain whether and to what extent coronavirus will lead to permanent structural changes in the economy. The creativity and adaptability of companies will be crucial for economic recovery. Structural policies can play an important role in fostering entrepreneurship through good framework conditions, thereby increasing potential growth. This is the best way back to sustainable growth and sustainable long-term public debt. Both are a prerequisite for broad-based prosperity and social stability. Thank you very much for your attention, and back to you, Kristalina.
Time to pick up some of the themes that you have touched upon and then go a little deeper. And if you don't mind, Thomas, I suggest we start from our original idea to have this conversation dedicated to low for longer interest rates. And actually zero on the reality that low and natural rate of interests are now predominant in advanced economies, large and small, and that, of course, has been helpful on many counts, but does have unintended consequences. And if you don't mind, let's look a little bit into some of these unintended consequences. And in particular, what it means for segments in society, like pensioners who rely on their savings to retain a good quality lifestyle over a number of years. How do you see the actions of central banks through low policy rates, unconventional monetary policy, facing some of these unintended side impacts? What would be your message to savers?
Well, Kristalina, it's a very difficult situation, and probably we all agree it would be much better to be in a situation where we have a little bit higher inflation, more growth and positive interest rate. I think life would be much easier for all of us. But for central banks, I think it's very important to have a very good idea about the equilibrium rate of interest. So it makes a huge difference whether it is structural issue about the real interest rate, the equilibrium real interest rate, whether it's at 2% or they're 0%. So your policy can be very different. And having very low rates may reflect to one extent just a change in the structure of the economy, but on the other hand also that you are very expansionary. So to know exactly where you are compared to a certain equilibrium is very, very important. And we cannot ignore the structural changes. So if the equilibrium of the real interest rate is now much lower than 20, 30 years ago, this may be a real fact. And we have to accept that, and we have to adjust our policy. This is difficult for pension funds, it's difficult for savers, but I think central banks cannot ignore that. On the other hand, we have also to be careful. It could well be that certain policies, especially when they go over a very long run, also have an impact, at least on the perceived equilibrium rate of interest rates. So I think there central banks should be careful so that we do not fall into a trap that we have ourselves a big influence on this R star in the long run. But as you mentioned, it is very, very difficult for some groups at the moment. The pension fund systems, also if I take the example of the one in Switzerland, they were built in the 80s under the assumption that nominal rates are something between 3 and 6%, depending whether you have risk-free or with risk. And now it's something between -1% and +1%. So this is very, very difficult to adjust. And it's no easy way out of that.
Well, let's look into one of the possible directions that could be taken. Then on its own, it has embedded risks. And it is to seek higher yield at a time when the stabilization of financial conditions has created again an opportunity for the sovereigns and also for private companies to go out on markets and borrow at reasonable cost. To put this continuation of our conversation in a context, I vividly remember in March when markets froze and we were incredibly concerned that even countries with strong fundamentals may be cut off. And then, of course, we had the actions of central banks in advanced economies, the fiscal measures taken in a massive way, some $11 trillion of fiscal measures, and then markets opened up. So comes April, May, June, July. Countries with strong fundamentals can easily borrow at low cost, and countries with not so strong fundamentals, they are accessing markets, offering these higher yields. So what would be your take on how this ease of access can help, but also what risk it may put to financial stability? And what would be your wisdom, your advice to those who are listening to us in this context? Do's and don'ts.
Well, this is a very complex question, and it's not easy to give you really advice to everybody. But if you take the example of the advanced economies, so we had a certain panic in financial markets. We did not even experience similar situation in the financial crisis. So it was necessary to calm markets down and to give assurance that liquidity is here in the market. But of course, this is a short-term impact, and the impact is here, and this is very helpful. The question is, what is the impact in the very long run? And I come back to the discussion we had before. So if there is indeed a structural change in the interest rate, much longer, then probably we have higher level of debt, and the economy, but also households can live with a higher level of debt because interest rates are much lower. But of course, the vulnerabilities are also higher. So if suddenly you have a change in the interest rate again, then firms, but also households may become in a much more difficult situation. So what we have is very strange. So we have now a period of more than almost 13 years, since 2007, when we had to become more expansionary, but never really normalize policy again. So we had to expand the liquidity, we had to lower rates, but we never got back to a certain normal level. So that could be a structural change, but it could also be something where we had a series of negative shocks, so that policy was always expansionary, and that we will have a rebound, a sudden rebound, also in the perceived risk and in the perceived interest rates, and then, of course, the situation may be more dramatic. So I think an advice would be that, well, policy has to be accommodative, but we should not forget about the long-term risk, about the long-term consequences. And I think neither households, firms, nor companies can always count on markets. So they need a certain level of equity, they need a certain level of robustness themselves in order also to survive more difficult situations.
So I take it that your expectation for a prolonged period of time of low to negative interest rates is helpful to continue a period of supportive policies, and at the same time we do need to be mindful of potential risks of debt built up to a point of unsustainable level. And I would second very much your conclusion in that regard. One of the issues you touched upon in your presentation was about price stability, and that you mentioned a flexible definition of price stability has some advantages. Can you say a little bit more on that? We know that ECB and the Fed are currently reviewing their monetary policy framework, including their definition on inflation targets. How do you see it? What would be your comment with regard to what other central banks might need to look into, and how you see it from a Swiss perspective?
Well, I can only explain our situation, and every country is a little bit different. You have very big currency areas, you have smaller countries. Our experience is that controlling inflation may be very difficult, and it can be also costly if you achieve a very precise target. And you have to make kind of a cost-benefit analysis, whether you can accept a positive inflation, but below 2%, and without additional reaction of from us, or whether you need further easing of monetary policy in order to bring up inflation a little bit. And if you take the last maybe 20 years, we entered also in a big phase of globalization. So that was probably linked to a phase where we benefited from a series of positive supply shocks, if you want. So inflation was structurally low. And the question was whether it is worth to be even more extreme with monetary policy just in order to bring inflation a little bit up. And given the big openness of Switzerland, and given that we are always impacted by these foreign developments, we came to the conclusion that for our case, a definition that says, well, price stability prevails as long as we are below 2% but positive served us quite well. Sometimes we were above, sometimes below, and then we took the measures that over time, over the medium time, inflation is back again in this territory. If you look at the economic performance of Switzerland, but also at the achievement of price stability, and I think also at the benefit for the public at large, the result was not bad as that. So even though we had difficult periods with very low inflation, negative inflation, it was always possible to bring inflation back. And we never had a situation where inflation expectations really deteriorated into a deflationary environment. So it was always the policy of the Swiss National Bank convinced, I think, markets and the people that we can avoid such a situation.
Well, one of the components of action in this new world of prolonged period of unconventional policy, in fact, I'm going to ask you, can we still call it unconventional policy since it has been with us for quite some time and we expect it to be with us for years to come? But in that environment of unconventional policy, low interest rates to negative interest rates, banks also had to adjust. They had to adjust once to the policy changes that came after the global financial crisis that put pressure on banks to have stronger buffers. And it also came from the need to adapt their business model to a situation when the traditional accumulation of savings and lending to generate income is challenged by the low to negative interest rates. So how you as a central bank of a country that has a long tradition of being attractive, especially in bad times, how do you see the banking sector of Switzerland, the Swiss banks performing? Are you satisfied with how they respect the need for buffers, how you see them adjusting to this shock from COVID-19? What is your, if you were to give them a mark, what mark would you give them?
Well, now I have to be careful giving marks, but I'm a little bit diplomatic in this answer. But we can say that the Swiss banking sector adjusted to all the changes in the structure of the financial market, but also to the regulatory changes quite well over the last couple of years. And today, we can be proud that we have quite a strong Swiss banking sector. Banks are capitalized very well. They have a high level of capital, also big buffers. So they are at the moment even profitable in this situation. So we hope that the banks are now part of the solution in this crisis and not part of the problem. But that was a long journey. So in the financial crisis, especially those banks who were internationally active were in a more difficult situation. So we changed regulation as everywhere in order to have more buffers, more capital in the banks, and also more liquidity. But that helped us quite a lot. I have also to say that banking, or doing the business of banking in this low interest rate environment, especially negative interest rate environment, is not easy. So we know that we have distortions in the system. As long as it's not possible to adjust the interest rates on both sides of the balance sheet exactly the same, it can create distortions. So we have to acknowledge that, and this is also the reason why we try to help the banks by having an exemption threshold so that they do not pay on all their reserves with the Swiss National Bank negative interest, but they have this exemption threshold. But in Switzerland, at least so far, banks, all banks, so those who are only domestically active, but also those who are international active, were able to adjust to this new situation, and profits did not decline so far. But they had to adjust, they changed the business model, they became more efficient, and they also extended their activities. So we have more mortgages and more loans, maybe with a little smaller margin. So these are all structural changes. And the point that we discussed before, the question is, what is the impact if this low interest rate environment stays forever or for long? What is then the overall impact on the banking system? And this is an open question, and I can just repeat what I said before. It would be, of course, better if one day we could go back again into a more normal situation, although I fear that it will take some time until we are there again.
One of the questions that have been debated is, should, in a period of uncertainty, when the risk of bankruptcies, while significantly reduced by the proactive steps taken by fiscal authorities and also by central banks, this risk is still there, and therefore banks might be faced with more pressure because of non-performing loans in a post-COVID environment. And then the question becomes, what should they do to prudently prepare for this potentially heightened risk. What should they do vis-a-vis dividends? What should they do vis-a-vis buybacks? How do you see this question being answered in Switzerland, in Europe, globally?
Well, we had this discussion, of course, also in Switzerland. Well, first, a very important point is that, well, banks are, in most cases, private organizations. So they have to bear the consequences of their activities. So if they take more risk, they may suffer losses. And it's always very difficult if they are pushed by authorities to take some risk where they probably do not like to take the risk. So there we have to be quite careful. I mentioned before, we hope and we believe that banks are now part of the solution globally, but also in Switzerland. But finally, they have also to do their risk management in order to make a judgment to what extent they are capable to actually take the risk on their balance sheet. And then they have to be aware of the difficult situation, and that links the question then to the dividends or to the payback. We told the banks that they should be careful, and especially all the decisions that we took to ease the regulation, for example, like to change the leverage ratio or to inactivate the countercyclical capital buffer, those alleviations should not be used for paying back or for paying out dividends or pay back shares. So here banks should be careful and they should be moderate. And in Switzerland, I think banks found a very good solution together with our regulatory authorities.
Well, very good. I recognize that it is an area where we all have to be very watchful because of the high degree of uncertainty. And that actually makes communication even more important. It was important before COVID-19. It is even more important when we are all in a higher uncertainty environment. So how do you see communication in SNB in this higher uncertainty environment? How do you approach your role in that very, very tough moment we all find ourselves?
Well, communication is very important always, but of course in this environment even more. And I can tell you it's not easy to explain to the public at large why we have negative interest rates. This is something very uncommon, and many people ask questions, and rightly, why do we need negative interest rate? Because the impact on pension funds, on my savings deposits, etc. So I think we have an obligation to explain that in the best possible way, and we have to explain that we cannot create a wonder. So we have to here make a certain trade-off between having difficulties for the economy, even deflation, or having an expansion in monetary policy, which means also very low interest rates and even negative interest rates, or interventions and then having a certain risk on the balance sheet. So it's not possible to have everything out at the optimal. So it's always a trade-off between things that have positive sides and negative side. And I sometimes say, well, if we could wish something for Christmas, I think we would have a positive interest rate, more growth, a little bit higher inflation, and that would make everybody happy. But unfortunately, we are not in such a situation, and we have to try to explain that to the public. I'm convinced that the public at large has a good understanding about the difficulties at this moment. But of course, it is very, very difficult also from a political point of view to adjust, especially the pension system, to a situation where revenues from bonds are much lower than they used to be. This is something that creates difficulties, big political discussions, and there I think we have an obligation to explain it as good as possible.
Out of curiosity, what is the most difficult question you had to answer, and asked by whom? If you were to zero on having to communicate in this complicated environment, what is the the most difficult situation you found yourself in?
Well, well, it's very difficult to say what is the most difficult question. So this is a little bit a surprise question you are asking at this moment. But
so you may say this is the most difficult one.
This is the most difficult. No, I am telling you what is the most difficult is, well, why is so bad when you have a negative inflation of 2 or 3%? So many people ask, well, this is good for me. So if interest rate is 0, at least prices go down and then I can buy more. So ordinary people sometimes say, well, why are you fighting negative inflation? That could be positive for me. And we are talking to many people on the street and they say, well, we love price stability. We do not like 2 or 3 or 5% inflation, but deflation, this is good. So we can buy more tomorrow. And then we have to explain, well, this is maybe good for you from this individual perspective, but from a more aggregate point of view, it may become difficult because this is also difficult for firms when they cannot sell the products at the same price. And it is also difficult because salaries, the real salaries increase too much and then the Swiss companies become less competitive. So these are the more difficult and tricky part, but the general public often does not really understand why everybody is aiming for higher inflation if low inflation and price stability is such a good thing.
Well, let me take you then to a similarly difficult set of issues, climate. One of the important things Switzerland has done early, and you have done early, is to recognize that there is a new type of risk to financial stability, and it is climate risk. Do you see in the current COVID environment the public derailing from this topic and making it more difficult for you to engage strategically on integrating climate risks in the way we ask disclosure from enterprises and from banks? Or you think that people are now more sober because of the crisis opening up our minds to the force of nature and the necessity for us to be more engaged on these difficult topics?
Well, I don't know exactly, but I believe it's relatively neutral. So this is a very important issue. And I think in Switzerland, we are all aware of the importance of climate change. And the economy, not only in Switzerland, I say globally, will change in a direction where we have less carbon and more natural energy use. I think this is very clear, and it is exactly, I think, also the work of central banks. We have to be aware of the risks, of the different risks. We are doing some work regarding financial stability, but also what is the impact on monetary policy. So the main task we have at this moment is what does climate change for fulfilling our mandate? Is there anything that changes so that we have to conduct monetary policy in a different way? Or what is the impact on financial stability? These are very difficult questions, so it's not always very clear. So we are starting to look at what type of risks are in banks' balance sheets, how much are they exposed actually to climate change, and then we see what are the consequences of that. But we have to to do this work very seriously, and the same is true for monetary policy. It's even more difficult there and less straightforward. What does it mean when you have a higher temperature globally? So what is the impact on monetary policy? Do we have to be more expansionary, less expansionary? So these are very, very difficult questions, and I think we have to put a lot of work into answering those questions.
I so much agree with you. We see at the IMF a tremendous significance of our ability to help define climate-related risks in the context of sustaining financial stability, and look at both the portfolio risks that come from transition to low carbon. If you are highly invested in high carbon intensity enterprises or sectors, how would you adjust? What is a good strategy to adjust, as well as climate risks related to climate shocks? And I want to finish by asking you, is it now a good moment to think about non-conventional monetary policy as it relates to embracing these kinds of significant new risks to financial stability? Obviously, we haven't thought of the pandemic as being risk to financial stability. Now we do. How can we define the next round of evolution of monetary policy in the context of this particular shock? What have we learned from it?
Well, again, Kristalina, this is a very, very difficult question. And I think we have to be careful regarding climate change. It's very difficult to argue that monetary policy will have a very, very big impact. So there are other policies will have much more impact on that. And we should be careful not to substitute other necessary policies by telling the people, well, if you change monetary policy, everything will be fine. I think that would be a mistake, and we have to be careful on that. And given the relative limited knowledge we have at this moment, I think it's also very difficult to say, well, doing that, then we know exactly what are the right consequences. So I think we have to do a lot of work in order to understand the risks correctly, and then you make the right judgment and to make the appropriate recommendations. But nevertheless, I think we should not forget that many other policies maybe have a much bigger and more direct impact on climate change. And it's, I think, the task of parliaments and politics to make the most important decisions in that respect.
Excellent. Well, Thomas, I can say from the bottom of my heart that I can speak on behalf of everybody that you have dealt with difficult questions in a very straightforward and clear manner. What is your last message you want to convey to our audience today? Where do you want to land this 7th Michel Camdessus lecture?
Well, Kristalina, let me thank you very much for inviting me to give this lecture. And I think my wish would be that people understand the difficult situation from small open economies. I think we depend a lot on what is going on around the world. These big central banks have a big impact, and we depend a lot on what is going on elsewhere. But we have to find a way how we can then adjust our monetary policy. So, of course, the international environment is very important for us. We also profit from globalization, profit a lot from a good economic situation elsewhere. But then we have to find our ways with our policy tools that we have in order to find a way to have appropriate monetary conditions. And I hope that I was able to a little bit explain you this situation here in Switzerland.
And you have done a wonderful job, Thomas. Thank you very, very much. Thank you.
Thank you very much.